Hey everyone, welcome back to Corporate Decoder. Today we're sifting through Tronox Holdings PLC's latest financial report. Get ready because this one involves some pretty big numbers and some interesting strategic decisions. Before we dive in, if you love dissecting these financial documents to see what is really going on, make sure to hit that subscribe button. And hey, we've got a great community over on Discord, link in the description, where we break down these filings even further. This is Tronox's quarterly report covering the period up to the 30th of September 2025. Think of it as a checkup on how the company is doing financially during this part of the year, giving us a peek at their performance and financial health. When we look at the top line, their net sales for the 3 months ending the 30th of September 2025 were $699 million. Now, this is actually down from $804 million in the same period last year. That is a pretty noticeable drop, about 13%. The company explains this is mainly because they sold less of their titanium dioxide, or TO2. And zircon products and the prices they got for them also went down. It seems like the market for these products has cooled off a bit. This dip in sales directly impacts their gross profit, which fell to $52 million from $128 million a year ago. This means the difference between what they earn from selling their main products and what it cost to make them got a lot smaller. Their gross margin, which is basically how much profit they make per dollar of sales after covering the direct costs, also dropped significantly from 15.9% to 7.4%. That is a big squeeze on their profitability. Adding to the financial pressure, they recorded restructuring and other charges amounting to $25 million in this quarter. This is linked to their decision to idle their TO2 plant in the Netherlands. This means expenses related to shutting down parts of their operations. This charge wasn't there in the same period last year, so it is a new and significant cost. When you combine lower sales, squeezed profits, and these new restructuring costs, it is no surprise that their loss from operations went from a profit of $54 million in the previous year to a loss of $43 million. That is a swing of about $97 million, showing a tougher operating environment. Over the 9 months of the year, the picture is similar. Net sales are down about 10% and they've posted a substantial loss from operations. Looking at the bottom line, the net loss attributable to Tronox Holdings PLC for the 3 months was $99 million, compared to a $25 million loss in the same period last year. For the 9-month period, the net loss ballooned to $294 million. This really highlights the challenges they're facing in this reporting period. Now let's skip ahead a bit to how they manage their performance. They use a measure called EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization. For the third quarter, their EBITDA was $30 million, down from $110 million a year prior, when they removed certain one-off or non-recurring items. They get adjusted EBITDA. For this quarter, it was $74 million, down from $143 million. This means even after excluding certain items, their core operating performance has taken a hit. The adjusted EBITDA as a percentage of net sales also dropped from 17.8% to 10.6%, showing less efficient operations relative to their sales. Here is a critical number for you: net debt to trailing 12 months adjusted EBITDA. As of the 30th of September 2025, this ratio stood at 7.5 times. This means it would take over 7 years of their current adjusted earnings just to pay off their net debt. This is a significant jump from 4.8 times at the end of the previous year. This indicates their debt load is becoming larger relative to their ability to earn profits. Their long-term debt net is sitting at $3.1 billion as of the 30th of September 2025. This is up from $2.7 billion at the end of 2024. They've taken on more debt, which contributes to that higher net debt to EBITDA ratio. Remember those restructuring charges. For the 9 months of 2025, they've piled up to $153 million. This is a major expense that was not present in the same period last year. It really underscores the significant operational adjustments the company is making. They also have this accounts receivable securitization program. Essentially, they sell some of their customer bills, known as accounts receivable, to get cash faster. As of the 30th of September 2025, they had $230 million in receivables sold through this program. It seems to be a tool they use to manage their cash flow. When we look at investing activities, their capital expenditures were $255 million for the first 9 months of 2025. This is money spent on things like property, plant, and equipment to maintain and grow their business. It's a substantial investment even as they face profitability challenges. Looking at the broader picture, Tronox operates in the chemical and mining industry, specifically focused on titanium dioxide. This market can be quite cyclical, meaning it goes through ups and downs based on global demand and economic conditions. Their main products, TiO2 and zircon, are used in a lot of everyday things, from paint to ceramics. The current report suggests that demand for these products has weakened and prices have fallen, which is hitting their sales and profits. The net loss as a percent of net sales for the quarter was a whopping 14.3%, a significant worsening from a 3.1% loss last year. This shows that for every dollar of sales they generated, they lost more money than before. Now, let's put on our Warren Buffett hat for a moment and look at the story these numbers are telling. Tronox is clearly navigating a challenging market. Their sales are down, their profits are squeezed, and they've taken on more debt. The decision to idle their Netherlands plant, while perhaps strategically sound for long-term efficiency, is creating significant immediate costs. This indicates they are actively trying to streamline their operations and cut costs in response to weaker demand and pricing. The higher net debt to EBITDA ratio is a key concern, signaling a greater financial risk if earnings don't recover. However, they are continuing to invest in capital expenditures, which could pay off in the long run if demand picks up and their operational improvements are successful. The market appears to be rewarding them with lower valuations this quarter, reflected in their adjusted EBITDA as a percentage of sales dropping. The key question is whether they can successfully manage this downturn and whether their strategic moves will lead to a stronger financial position when the market turns around. The company's future success will largely depend on global economic recovery, increased demand in their core markets, and their ability to control costs effectively. Alright, that is our take on Tronox's latest financial performance. What do you think about their strategy and the challenges they're facing? Let us know your thoughts in the comments below. If you found this deep dive valuable, give us a thumbs up and don't forget to subscribe for more corporate breakdowns. We also have a great community over on Discord, linked in the description, where we dive even deeper. Thanks for watching and we'll see you next time.